start with a quarterly overview. So when I look at April and I look at May and I look at June, what's the commonality here? Green, green, green all over the screen, screen, screen. There's a holiday we just passed in April, and that is Good Friday. We have a holiday in May, which is Memorial Day. That's that final Monday that we see there in May. And then, of course, we've got the newest of the holidays, which is Juneteenth, which is Friday, June 18th. Those are 3 days that the markets will be closed. But every other day, excluding weekends, we are open. And every day, excluding those holidays and weekends, we have trading opportunities. So out of those opportunities, what I do is I will look into the days. I will look at those areas and I sort these. And I'll sort these by, I like to see number of trades. I like to see clusters of trades. If I see total number of trades out there and it says 1 beside it, I want to see something that is greater than 1. All right. Days held give me an idea how long I'm going to be hanging on to that pattern. That percent return, I typically jump to the average return per year. That's more important to me. How accurate has it been in the last 10 to 20 years? When was the last last loser? And if I get a goose egg beside it, guess what? That means that it's 100% accurate during that pattern. When is the end date of the pattern? That helps me determine, if I'm an option trader, what expiration am I going to be using? And then we got this thing over here called Power Meter. And Power Meter looks at each and every year of the pattern and puts those together and tells me whether that pattern is becoming more positive as we get to today or more negative. So I do a lot more with seasonality than just the average seasonal trader. And so I can go in and look at those details. And I can look at those stock details and get those patterns. So my top seasonal trades for you for spring of 2026, I've got 3 of them for you. 1 for this month. Actually, 1 starts like next week. Then I've got 1 for May, and I've got 1 for June. So here they are for you. First stock to talk about is Synapsys, SNPS. This has a bullish pattern that starts on April 13th. This pattern has produced a 14.6, and I call this a PROI. That is a projected ROI based on the last 10 years average in the last 60 days, or the next 60 days, excuse me. So a little bit more about Synapsys. Again, when I go in and I look at Synapsys and I bring it up, this is what the patterns look like. There's not been a single year where this pattern, starting April 13th and going out 60 days, there's not been a single year in the last 10 years where this has lost money. If you look last year, 35% return. But take a look at all 10 years and you'll see, the biggest return was during 2020. We saw a lot of stocks from, the months of April, May, and June just excel out of the COVID. All right. They were cured of COVID, after March. And so for 2020, Synapsys was up 42.75%. Its worst was in 2022. It was in 2022 when we had just 1% over. But remember, 2022 was a bear market year. So that's not bad. So when I take a look at a chart of Synapsys, and I'm bringing this up with our software, I'm looking at using the Hub software. The green pattern that I have highlighted there for you was last year's bullish pattern, right? That bullish pattern between April and in going out 60 days, April 13th to July 7th, jumped 35%. What's interesting is Synapsys was coming off of its bottom back then, but it didn't come near its top when the pattern was over. All the pattern tells me when we're not in that pattern is I don't have any seasonal bullishness or seasonal bearishness. It's only within the pattern, within that start date and end date, where we're looking for opportunity, because opportunity, was not around, but it's coming around very, very soon. What's happened since then? Well, we've seen Synapsys go from lows of the high 300s up to nearly $650 a share, right back down. It's been bouncing around this bottom. And it's formed a really nice triple bottom down here, but now it's coming into a bullish pattern. So if this triple bottom holds, as the pattern is suggesting it's going to hold, it did a 35% jump last year, but I'm only looking for the average. So from here, spot the opportunity. What's the next thing we do? We look for an alternative risk trade. I could buy the stock, but how about we look at an option trade instead? And so even though we are still a week before this trade takes shape and becomes a start date, if I were looking at it today, what would it look like today? So I took last year's money pattern and I took the average and I came up with an average price target of $450 based on where the stock price is today. I went into the options and I looked at the calls, and the calls were $40 to buy the calls. But the call spread, buying the 440 call and selling the 450 call, you could do that for $225. That was $2.25 times the actual spread itself. So $225 costed risk, $775 maximum profit potential, and has a break even of $443. Why did I choose the strikes that I did? I always start with the sell. All right, if my target price is 450, then that's where I'm getting out. So let me work an option trade in between where we are now and where I expect or project that target to go. And that's what gave me this 3-to-1 reward to risk ratio trade, right? Risking, I have a potential of getting $3 for every dollar I risk. So if we were to look at this, and let me show you real quickly how I went from this to this. All right. So what I did was I popped out here on the site and I went to the price pattern for Synapses. And then I got all the option charts down here. Now I'm looking at July because that takes me out just past the date that I'm looking at for Synapses to move. And the July options, we're close to 400. So I'm looking at the 400s. And if I were to buy, again, I can buy the 400 call, but that's going to cost me somewhere around $40. But how about creating a trade near the target? So if my target's 450, why not sell the 450s? All right, calls on the left, puts on the right. And then why not buy the 440s? I could buy the 440s and I could sell the 450s. That is a call spread. All right, let me blow this up so you can see it. There's the strikes. What am I doing? Buying a lower strike call, selling a higher strike call. All right. Now, puts on this side, I don't need to look at those, but here's my details, folks. Over here, shows me exactly what I'm looking to buy. All right, buy to open, 440 call for July, sell to open, 450 call for July, cost max risk 225, max profit 775. And then if I want to turn this into a risk curve and actually look at this, like an option trader, I can click on the risk curve tab, and that brings in the actual trade right here for me to look at. And I can look at that maximum risk, and I can look at that maximum profit. I can bring this down and out of the way. And now here, if this trade just goes up to my 450 level, I'm already out here. Anything above that, I've capped, but I've also capped my risk. So that's how I went from this chart right here, which is just price, the stock trader, to an option trader. And the option trading price, I need 4 things. I need last year's money pattern, where it's going, the target price, target time, which money counter gives me. And I put together a trade that is inside the price and time area. Got my option strikes to the left, got my option details to the right, and there we go. So let's do some comparisons. So if I looked at Synapses and I want to compare this with a target of 450, if I bought 100 shares today and it's trading around 400, it would cost me $40,000 to have 400 shares of stock. Now, if we went to 450, that would be a $5,000 return. $5,000 return on a $40,000 trade. There's your 14%. But if I bought the 400 calls, that cost me $4,000 a contract. Now, here's some math. If I buy 400 calls and stock goes to 450, what are those 400 calls worth? A minimum of 50 points apiece, or $5,000. If I pay $4,000 for something that could be worth $5,000, I only make $1,000 on that trade unless it happens a lot sooner. Then we have a potential return of only $1,000. That's a 20%, 25% return on investment. All right. So we call that a 1-to-4 reward to risk ratio. You make $1 for every $4 that you risk. And finally, the July 17th, 440, 450 call, I just showed you that call spread. You're buying the lower, selling the higher. Right now, that's trading for around $2.25. That would be $225 per contract with the chance to make. Remember, you take the 10 points between the strikes, subtract out $2.25, and you have a $7.75 return on 225 risk. That's a 3-to-1. That's better than a 3-to-1 reward to risk ratio. Okay. So that's taking you from again, taking that order. And what did we do? So we took the trade and we spotted an opportunity, and we used the money counter to spot that opportunity. The next thing we did was we took SNPS and we ran it through our strategy synopsis. We ran that through an option strategy, and we were comparing the stock to a call, and we were also comparing it to a call spread. And then finally, what we did was we simply looked at the call spread and determined that the call spread is much less expensive than the call option. So if I go through and I do my 3-step process, spot the opportunity, create the alternative risk trade, the last thing to do is to plan, execute, and manage the trade. So when we plan, execute, and manage the trade, it's a matter of going and seeing, what can this be done? Can this be done through my broker? So if I pop out there, and here's an example of a broker, Robinhood, right? Robinhood, that spread closed at 250. So, so it is that 225, it's gone up a little bit there, but that's still potentially something that's doable if it actually comes into play next week around that price. I like it. I like it at that 250 or less. So I wanted to share that with all of you that were with me. Again, spot the opportunity, plan the low risk trade, and then execute, manage. That's what we do. So from there, let's talk about the other two, and then I'm going to go through these a little quicker because they don't happen until May and June. But my second pattern starts on May 4th. That is Generac. You know what Generac makes? They make the machines that give you portable power in the event of a power outage. Generac pattern starts May 4th. That's a 24% projected return on investment on the stock, not on the options, on the stock, over the 60 days preceding May 4th. Okay. Pattern looks like this. Here is the 9 in the last 10 years, but in 2016, a little sliver of a loss. Every other year, it's been some really nice patterns. 58% last year. How in the world did that happen? Well, we had a big move on generators last year, right? So during this season that started in May, big push. But I mean, that wasn't like sitting out there on its own. There's a 37% in 2023, a 34% in 2021, 45% in 2020, 30% in 2019. This thing has a chance to get up and make some big moves. Last year, or coming into this year, there's last year's pattern. Coming into this year, you can see that it made a huge swing for the first part of the year. Ran 2026 from below 150 up to near 250 before pulling back. This particular stock loves to be the alpha, okay? So again, that's Generac that starts on May 4th. Finally, my June pattern is Oracle. Oracle starts on June 8th. This is an 11.4% projected return on investment in 37 days, right? Starting on June 8th. The pattern looks like this. It's 100% winners. 100% winners, a lot of double-digit winners, but last year, 45% moved to the upside. There was a lot coming in, news on Oracle that really pushed it higher, but even just the averages themselves look really good when you look at the straight line average, all right? The power meter average says this thing's got a potential to go 20% higher, even though the straight line average is 11.4%. Again, I'm talking about the stock only, not talking about the options here. Chart looks like this. This was last year's pattern, all right, from the June start date going forward. Then we saw what happened afterwards, a big gap up with Oracle, pushed it up to above 325. Since then, it's been dropping, but it looks like it's coming into an area of support for 2026.